Today, we will talk about accretion, a key concept in finance and accounting. Accretion is the gradual and incremental growth of assets and earnings due to business expansion, a company's internal growth, or a merger or acquisition. In finance, accretion is also the accumulation of the additional income an investor expects to receive after purchasing a bond at a discount and holding it until maturity. The most well-known applications of financial accretion include zero-coupon bonds or cumulative preferred stock. In corporate finance, accretion is the creation of value through organic growth or through a transaction. For example, when new assets are acquired at a discount or for a cost that is below their perceived current market value. Accretion can also occur by acquiring assets that are anticipated to grow in value after the transaction. In securities markets, purchasing bonds below their face or par value is considered buying at a discount, whereas purchasing above the face value is known as buying at a premium. In finance, accretion adjusts the cost basis from the purchase amount to the anticipated redemption amount at maturity. As interest rates increase, the value of existing bonds declines, which means that bonds trading in the market decline in price to reflect the interest rate increase. Since all bonds mature at the face amount, the investor recognizes additional income on a bond purchased at a discount, and that income is recognized using accretion. The rate of accretion is determined by dividing the discount by the number of years in the term. In the case of zero-coupon bonds, the interest acquired is not compounding. Assume that an investor purchased a $1,000 bond for $860 and the bond matures in 10 years. Between the bond's purchase and maturity dates, the investor needs to recognize additional income of $140. When the bond is purchased, the $140 is posted to a discount on the bond account. Over the next 10 years, a portion of the $140 is reclassified into the bond income account each year. The earnings per share ratio is defined as earnings available to common shareholders divided by average common shares outstanding, and accretion refers to an increase in a firm's EPS due to an acquisition. For example, if a firm generates $2 million in available earnings for common shareholders and that 1 million shares are outstanding, the EPS ratio is $2. The company issues 200,000 shares to purchase a company that generates $600,000 in earnings for common shareholders. The new EPS for the combined companies is computed by dividing its $2,600,000 earnings by 1,200,000 outstanding shares, or $2.17. A primary example within corporate finance is the acquisition of one company by another. First, assume the earnings per share of Corporation X is listed as $100, and earnings per share of Corporation Y is listed as $50. When Corporation X acquires Corporation Y, Corporation X's earnings per share increase to $150. This deal is 50% accretive due to the increase in value. However, sometimes, long-term debt instruments, like car loans, become short-term instruments when the obligation is expected to be fully repaid within 1 year. If a person takes out a 5-year car loan, the debt becomes a short-term instrument after the 4th year. Here are 3 key takeaways. 1. Accretion refers to the gradual and incremental growth of assets. 2. In finance, accretion is also the accumulation of additional income an investor expects to receive after purchasing a bond at a discount and holding until maturity. 3. The accretion rate is determined by dividing a bond's discount by the number of years in its term to maturity. Hope this would help. Thanks for watching.